Jim, I'm going to start with you. We have been relatively on an upward trajectory. I think the real question now is, does it last? We have questions, obviously, about whether stimulus is needed. And then, of course, we have an election coming up, which could create some more volatility.
Yeah, I think obviously volatility is going to come back into the market, and we're seeing that now just because the rate of change of the recovery and the V-shape off of that March lows is starting to slow down. But as you said, we're at a period of time right now as we get into the election. There's a lot of uncertainty about what that means, what's going to be the outcomes, what shifts in policy we might see. We've also seen some of the virus data in Europe start to spike a little bit. All of that creates a little bit of a period of time where positioning is high, and we're at the end of the year. We're starting to see some sell-off. That being said, I think if you look through this and look longer term, you're still at a point where the data around hospitalization rates, mortality rates, and or vaccines or treatments is getting better. And I think regardless who wins the election, you're still coming into a policy that will be accommodative and supportive for economic growth. And I think you'll see a multi-year recovery here to get back to the levels of 2019.
So just to put a fine point on it, in terms of an entry point, you think right now is just as good as ever a time?
I do. And I'm not saying that you can't have a little bit more volatility or sell-off here into year end on the positioning. But I think if you just look at it, because of the debt, because of the position we're in post-2020, you have a 60 to 70 basis point 10-year. Global rates are going to give you very low rates of return. And when you look at from a long-term investor, now is a good entry point because I think you have supportive policy and earnings recovery over multi-years. And I think that where you're going to get an excess return, although not the same returns you saw over the last 6 months, today's still a good point to buy spread product or credit and even equities to enter in here and add as it goes down.
Gabriella, you agree with that assessment?
Yeah, Andrew, we have a positive view on the direction of risk assets in the medium term. For equities, we still think we're in a structural bull market and at the beginning of a cyclical bull market. The data is moving in the right direction, and we expect to have plenty of policy support for the first few years of this recovery. But we would very much agree that volatility is still in the cards for the next few months. There's a lot of event risk around the election. There's positioning risk affecting the leaders of the rally. And there's some fundamental concerns around fiscal policy and the virus. So I think you do still want to be overweight risk assets, but you want to be careful with the positioning, sizing, and you want to balance that with some diversifiers on the other side as well.
In terms of what that mix looks like, we always talk about the tech companies and the underloved cyclicals that haven't really been touched yet. Do you want to be in those now if you really think a vaccine either gets announced? I don't know if it's an announcement that somehow those stocks are going to move. Maybe that'll be the big move. Maybe that move is not going to be meaningful. How do you see that?
So we would want to be balanced between growth and value. So I would say 50-50 on the equity side, because on the growth side, they're defensive for the COVID era. They're going to continue being structural themes after the pandemic, but there's positioning risk. On the other side, for the value side, there are fundamental concerns right now, but those can turn into catalysts later on once we get more visibility around a vaccine in terms of timing, distribution, more visibility on treatments, and also just more visibility on fiscal policy as well. So there are pluses and minuses on both sides. So why not be balanced between both? And you don't have to just do that within U.S. equities. You can be positioned in U.S. equities for the growth side of that equation and in international for the value side of it.